Hello, REEP investors and hello, apartment investors. I'm Jacob Garza, and with me is Arleen Garza.
Hi, everyone.
And we are here to host another edition of the REEP Huddle. And this particular one is regarding a retrospect on 2025 and what to look for, we believe, what's going to happen in 2026. Perhaps I should change that. I think we should be saying what we're hearing should happen in 2026. But I do believe at the end there's going to be more predictability that's going to happen in 2026, and we'll point to some of those reasons that finally we believe the not only we see some stabilization, we're going to see some improvement. But with that, Arleen, you ready to start?
Let's go.
Okay. We'll look at the 2025 market trends, kind of what happened. Arlene?
Sure. So, as we've shared before, we are strictly focused in the Texas market. So we're going to focus on the market that we operate in and buy in. So we wanted to share some data on what's happening from a demographic standpoint. So I heard a demographer who spoke at an event this year, and he looked at it was for crew, commercial real estate women, and he was looking at the different real estate segments and how demographics really impact that segment. So, in a nutshell, he basically said, if you're in multifamily, you're in a great spot because there are lots of renters and lots of growing numbers of renters. So, let's look at the numbers there. So this year, Texas welcomed over 265,000 new residents, which is fantastic. We'll take them. Coming from more expensive markets like Chicago, New York, the West Coast. And the bigger groups that came in were millennials and Gen X. They make up 75% of the folks coming into the Texas market. And what's bringing them to Texas are job opportunities, lifestyle appeal, and affordability. As an example, most of the markets across the U.S., Texas is at least 25 to even 40% cheaper to live, specifically from a renting standpoint. So that's important to know. So, what are some of the examples for San Antonio, which is the market we're headquartered in? Average rents are 1192, which is about 20 to 25% below the U.S. median. So again, a draw is affordability. Gen X and millennials, as I mentioned before, represent 41.08% of the population and 53% or over half of those that choose to rent. So it's important for us to know these groups, to understand who they are, what they're looking for. And for example, Gen X renters, they want family-friendly layouts, safe neighborhoods, and stability. So as interest rates rise, these groups are not able to or don't want to buy a home. Recent study a survey done with millennials, only 30% saw themselves owning a home, which is fantastic for our renter market, our properties, and the multifamily industry overall, because we will continue to have a lot of renters. So that's exciting data to share with you. So let's talk about another factor that's impacting renters, interest rates. So this is saying that mortgage rates exceeded 7%. Well, they've dropped some, but they're still, from 6.1% to 6.3%, 30-year mortgage rates. So renting is significantly more affordable than buying. So more folks will continue to rent versus buying homes due to things like not only interest rates, but housing pricing or more housing values have gone up and are projected to go up by another 4% nationally in this next year. So, renters on average are saving nearly $400 a month by renting versus buying a home, a 30-year mortgage on a, affordable home, even at that rate. But the big story is also supply. You've probably heard it about different markets across the U.S., Texas in particular. As developers see that people are, coming in droves to the Texas market, developers also wanted to build. And so they have over the last 3 years. We hit historic high levels of new apartment deliveries in the market. And, but now what we're seeing, thankfully, is that the gap between the new properties that were delivered, rental properties, apartments delivered to the market, and the absorption, which means people renting those new units, has narrowed to 500 units, for example, in San Antonio. And the other thing to note is that new multifamily construction, this says constriction, it should say construction permits, dropped by 80%.
It's right, constriction. It's
It's
good for us.
constriction and
Yeah.
construction, both. So what that means is there won't be a lot of new properties delivered over the next, call it 2 to 5 years, because it takes a while for uh, developers to get through the buying the land, going through the permitting, developing the plans, actually building and delivering. So we've got a good 3 to 5 year window where supply should not be as big of an impact to us in these Texas markets. Houston, um, the surge contributed to increased occupancy levels overall, meaning the absorption surge. So Houston is one of those large markets, over 7 million in population, where developers like to go into that market first. And Houston usually sees the impact of any economic change first, but usually is the first market to come out of it because of its large size. So occupancy levels are increased overall in Houston because units have been absorbed for the most part, and construction activity is also down 50% year over year. So those are two of our primary markets we buy in, along with Austin. Now, Austin is a different story. It continues to have a very active construction pipeline. So that has impacted rent growth over the last 3 years and is projected to be a factor over the next few years as all of those new units get absorbed. Now, Austin is Austin. Rents are higher, so that's a, compensating factor. And there's still a lot of folks moving into Austin. So over time, those new units will be absorbed, and it will also hit more of a stabilized factor like Houston and San Antonio. Now,
I got
let's
that.
look at the next thing, Jacob.
Yeah, so Arlene did a very good job of covering what I consider some of the factors that are out of our control, right? We have interest rates, we have builders coming in and building, we have the economy, we have layoffs, we have job increases, whichever you want to call them, and our ability to counteract that is with obviously our competitive edge, and that's how we go about managing these properties. So, you guys have heard me say that the year the 2020s was the decade of the management company, and boy, is that continuing to ring true today. So, we're just sharpening our saw with customer service, and we've been drilling down on this for years now. And we try to make the first impression, whether that's a lead coming in from multi what do you call that, social media, or actually coming in on site. So we've just put in different factors and touch points in place just to really make them welcoming, because residents do have even a greater choice today when they rent. And we have to treat every single prospect with urgency and care and passion. So we feel like we've done a really good job with that. And when they walk on property, and you continue to see our properties, they look very, very good. We just do a really good job of walking in, and the doors are clean, the mats are clean, it smells good. The all the facilities and amenities are wiped down and kept nice, and that's helped us along the way. So that's where we are competitive wise today. So um, I'm not going to go down that whole list that you see there, but that's what we're doing, and we continue to do. And I think that helps build community. And when you have a good community and you do your work orders and you've done everything you can to bring them in, you have to keep them. And we work our tails off to keep the resident there, because that obviously impacts the NOI. And we're fighting for every dollar of that NOI today. As we've seen challenges in occupancy and rents in this soft market. So it's just been a real success story, and hats off to our management company. So you can see there, a couple of residents at some of our properties have been there for just a long time, and I think we can repeat this process throughout the rest of our portfolio. So that's been a real gift for us, and we continue to work through that. So the next slide just talks about just a couple of people who have commented on our ratings. When you go to look for something to buy, I mean, whether it's Amazon, you probably stand with Amazon, but when you're certainly going to the internet and look on Google reviews, everybody hits Google reviews. So we worked our tails off to solicit to those on anything. This can be from a particular issue that we solve successfully. We want to know how happy they are, to their rent move in, to their make ready. How did that look? So we've gotten some really good responses, and some of these properties we've actually increased the Google rating up, a point or two. So now those move very slowly, but it's top of mind for us, and we even have little QR codes in our properties that we do that. So with that, Arlene, anything else?
No, I think that's great. We do monitor every move-in and every work order, service order, by giving residents an automatic opportunity to give us a review and feedback. It's important for us to constantly monitor, how well our teams are doing, and when there's a need for, corrective action, we also do that. So that's great. Thank you for sharing that, Jacob. Proud of our teams. They work really hard. So what is the future outlook and what we're seeing from and hearing from others? This just isn't us, it's others in the market for 2026. So we continually talk to our investors, and in a recent survey we did, 46% said they expect to invest more than 100,000 in the next 12 months. So 46% of them. 87% of them prefer a passive investment. So in real estate, you can be active buyer or a passive investor. And our passive investors love the fact that we take care of everything at the property. We manage the properties. We provide the reporting. We send you your K-1s. We send you your all of the property reports monthly through the investor portal. So that is something that we're finding is very important to passive investors. 96%, I'm sorry, 90% said multifamily real estate was their most desirable asset. Again, driven by the fact that people need to have a roof to live under, and we're still, over 4 million units undersupplied across the country in multifamily rentals. And so, as we saw earlier, with more people coming into the state, this is a good thing and a reason why many investors like multifamily real estate. Now, when looking at a multifamily investment firm to invest with, 84% of them said the track record of delivering positive results was the most important thing. And we see that too. It's betting on the jockey, not the horse, as we hear many, many times. So looking at what are economic and market projections? Well, let's start with again, Texas, that's the market we're focused in. The top Texas metros are in the top 10 markets in the U.S. for population growth. So Dallas-Fort Worth was listed as number 1, Houston number 2, Austin number 7, and San Antonio number 9. So what this means is, because we are seeing great population growth in our top 4 Texas metros, we'll continue to see demand for rental housing. So that's fantastic. Where you have demand, you have opportunities. And the other thing that we are anticipating will impact the market is a potential stabilization or decline in interest rate. I haven't heard if the Fed lowered rates today and how much, but they were project 89% chance of them reducing interest rates. So when interest rates come down, you typically see more investors entering the market, in particular, institutional investors. As more of that capital comes into the market, you drive more competition for properties, therefore increasing property pricing or values that sell in the market, which is good. and compressing cap rates. We want to see compressed cap rates so that in the future, as we sell our properties, we'll sell for a higher price. Now, looking at what are our strategic priorities in this market, staying agile and proactive. Right now, we're seeing, and we'll share it in a little bit, a lot of loan maturities. And what does that mean? How does the market shift impact us? We're still seeing 25 to 30% discounts on properties, meaning the pricing of properties that are on the market. Now, one of the challenges is a lot of properties, whether you're stabilized or not, are pricing based on distressed asset pricing. So that has pushed pricing down, which has contributed to these discounts in the market that we're able to go after. Now, for investors and for us, we're looking at long-term value creation. So real estate is a longer-term investment. So you need to look at that, the investment as a longer-term vehicle. And that's so when we underwrite, we're underwriting for the 3 to 5 year hold at a minimum. And we're also focused on resident satisfaction to maintain a competitive edge. Jacob talked about the surveys that we do and our ratings, our Google ratings. That's very, very important. And we focused a lot on resident retention this year. And we always do, but in more detail, we looked at resident retention because if you can keep a resident, it's going to save us on average $3,500 and not having to repaint that unit, new flooring, et cetera. So our resident retention numbers have gone way up, and that's because we are focused on really keeping the residents that we currently have. It saves us money all the way around, and it's also testimony to our teams keeping them happy while they're there. And we're also focused on driving NOI, net operating income increases. How are we doing that? I read an article recently that really across the board, rent growth, we are seeing rent growth. It's not as high as it's been in the past. So what's another way to increase net operating income? Well, that's through operational and expense improvements. So we looked at things like our insurance, as we've mentioned before. Second year I've been to London to talk directly to insurance underwriters. So we were able to get a 25% reduction this year. We got a 30% reduction in our insurance cost. And these are hundreds of thousands of dollars that it saves the property. So that's an example of some of the things we're doing. On the operational side, we've implemented AI tools that help us on the screening of people when they come through the door wanting to apply for a new lease. We use AI tools. In the first month we tested it, we had a 25% increase in declines of new leases. And that's because of some fraudulent documentation that these folks had presented. So it helps us avoid those situations by using that tool. We're using it in our leasing follow-up. We're using it on our maintenance tracking, among other things. And we'll continue to invest in AI and our tech stack that we use at the properties to drive NOI increases. So some of the things that we as a company are focused on for 2026 and beyond. And I didn't follow it before, but the Fed did cut 25 basis points today. Thank you, Jerome Powell. We need to see more of those, but every time the Fed cuts interest rates, as I said, it does get people more excited about investing in real estate, in particular multifamily. So
What's his name?
Jerome Powell.
Too late, Jerome Powell, or
Oh,
too slow,
I don't
Jerome,
know.
or something like that.
I don't know. I'm just happy to be
I
getting
want to
a
get
cut.
that right for the record. So
Yeah, I'm just happy we got a cut and
true.
hopefully continue to see that trend
Yes.
going forward. Okay, so let's look at what are the Q3 trends for 2025. This is all data we are constantly receiving reports from our broker partners, the top brokers in the US. And so we want to share some of the trends that they are seeing in our markets. Again, we're very, very focused on our markets. So let's look at San Antonio first. So occupancy remains steady at 93%. It's slightly below the state and national averages, driven by some of that new supply that entered the market last year and this year. Last year was 12,000 units. This year was 8,000 units delivered. But again, new construction permits are down 80%, so we don't anticipate seeing much new deliveries in the next 2 to 3 years. So the stability and occupancy also suggests that, demand is aligning with completion. So as I said, average rents 1192, roughly 20 to 25% below U.S. median. So it is an affordable market, not low income, but affordable, or we like to say attainable. Rents that are attainable for the workforce that we house, nurses, teachers, first responders. And so we like the area that we focus on, which is workforce housing, because there are a lot of folks that are in that market that need to rent. And for example, teachers and policemen, they're not getting job cuts. So they will continue to have very steady employment. Now, construction activity has contracted sharply, as I said. Now it's fewer than 4,800 units to date in San Antonio. And, the demographers or the statisticians look at it and say, when new development falls below 2% of its existing inventory, that signals equilibrium within 12 to 18 months. So San Antonio has reached that. So that's very good news. So rents have adjusted modestly. Occupancy has held firm. Now cap rates have widened above national averages. So that means, a lower per unit pricing, which is good if you're buying, not good if you're selling. But a lot of investors looking for yield are coming into the market and shopping in San Antonio for new properties to buy. Now let's look at Houston. It achieved its strongest absorption performance in 4 years, absorbing over 10,293 units, twice the number of units delivered in the third quarter, which is fantastic. Again, what that means is there is demand for these units, so they're being absorbed by new renters. Each property class except Class A posted their highest absorption letters. Class A properties, of course, are typically the ones that are being built. Nobody's building typically Class B properties. So that's the reason for that higher percentage of 42.7%. And, construction activity is falling way below quarter to quarter and 54% down year over year. And the Northwest submarket, which is where the majority of our properties are located in Houston, led the region in activity. So Northwest is popular. In fact, in Houston, what we've seen over the last probably 4 years is that over 50% of the growth has been in the suburbs, Tomball, Atascocita, the Woodlands, those areas where we have purchased properties. So all more positive news for Houston. Now let's look at Austin. Again, as I mentioned in the beginning, new apartment supply continues to rise in Austin. A lot of this is because folks committed to these new properties, call it 3 to 4 years ago, when there was a lot of robust need. There still is need, but a lot of the developers developed at the same time, resulting in a supply glut in the Austin market. There were 17,967 units under construction in the third quarter of 25, with additional units expected to break ground in this fourth quarter. Overall asking rents have dropped for the ninth consecutive quarter, now at $14.41. Now in Austin, we own one asset. We are closing on a second asset this month, but the asset we own is a B class asset, a solid B plus asset. So it doesn't compete head to head with these new Class A units that are being brought into the market, which is really driving the affordability concept, because these units are being delivered are, 2,000, 3,000 plus rents per month, and ours are, on the $1,200 to $1,300 side. So our property continues to do well in that market. The second property we bought and closing is a townhome community. And that is a different product. It doesn't compete necessarily directly with the traditional multifamily because it's more like renting a home. And so that asset is in demand and there's not enough of that supply. So we're excited about that new asset coming into the market. So that is the three markets that we are currently in. Now let's talk about new opportunities for acquisitions. So distressed assets, you've heard this probably if you follow anything about multifamily. It's a word that's been tossed around now for probably 2 years. What has happened is the lenders that lent on some of these distressed assets extended and pretended. So they extended the loan and didn't really take action, even though maybe the property was entering financial distress, which was caused by the 11 interest rate hikes that happened over a short period of time, as we know, when the Fed raised interest rates. So some of these properties may have been purchased with, call it a 3.5% interest rate. And with the 11 interest rate hikes, their interest rate rose to 7%, 7 to 8%. So a lot of the cash flow from these properties went to pay the mortgage. So there wasn't a lot of cash flow left over for other things. We purchased an asset 2 months ago in San Antonio directly from a lender. The property was not distressed from a physical standpoint. It looked very good, but the owner was facing financial distress. As I said, their loan, they couldn't support the loan. So we bought the asset directly from the lender and modified the loan. So that's the type of opportunity that is out in the market. How do we get these opportunities? Well, it's through our strong broker relationships that ensure that we're getting those calls first on these opportunities. And that's because we have a strong reputation in the market. The other thing to look at is what's coming. The loan maturities projected in 2026 is $162 billion. These are multifamily loans that are maturing. 167.70 billion are maturing in 2027. Now, if interest rates don't drop significantly, they will not be able to refinance. Some will, some won't. Multifamily loans account for 32% of all commercial real estate maturities through 2026, reflecting how prominent multifamily loans are in the market overall. But only 21% of those loans maturing expect to achieve a refinance. So what does that mean? That lender will most likely need to or force a sale. And in today's market, those assets are being priced below market, 20 to 30%. And so that creates opportunities for people that are active buyers like REEP. So we will continue to look as these assets come due and looking at these loan maturities and talking to not only brokers, but lenders who have even approached us about partnering with them since we do have in-house property management. They want to work with groups like us, either in the interim while they're having to take over these properties or as a partner to stabilize these assets into the future when it's a better market to sell. All right. How do you future-proof your investment strategy? Well, I think this is really tied to what we personally do also. We focus on long-term value creation, growing that net operating income at the properties. The properties, multifamily properties are valued on the net operating income. So the higher you can take that net operating income, the higher you'll be able to sell for in the future. Navigating market volatility with strategies that ensure portfolio stability. Portfolio stability is very, very key. Being knowledgeable of what's happening in the market and running the properties consistently day to day is really important. Strong broker relationships, we cannot stress that enough. That ensures that we get the better opportunities come our way. Building a diversified portfolio across markets, property types, and asset classes is very important. For us, being in Houston, San Antonio, Austin, and we are looking at Dallas-Fort Worth pretty heavily. it helps diversify for our investors because they can invest in different markets, different submarkets, et cetera, and taking advantage of the tax benefits. As we all heard this year, and we're excited about the one big beautiful bill passing, it reinstated 100% bonus depreciation. So for some investors investing $100,000, you're getting back anywhere from 65,000 to 75,000 in bonus depreciation year one to hopefully offset your taxes now or offset them in the future to offset any potential gains. The other thing is to reinvest your tax savings into new growth opportunities and expand your portfolio. Maximize your after-tax returns by applying the new legislative advantages. So a lot to keep in mind. We did a tax-oriented webinar a few months back. You can find it on our website that we did, and it has some additional tips on taking advantage of the tax benefits.
Okay, so closing thoughts. Well, I think what I said earlier was continuing to offer the customer service and really just be buttoned up at the first interaction of a prospect, all the way through when they choose to leave the property. And I think we've done a really good job of doing that. Ability and agility. I mean, it's the old improvise, adjust, and attack, right? That's what we have to do, especially today. We have to stay very creative in all of our thoughts operating these properties, and just continuing to find ways to make the customer happy. That's really where most of the stability is coming from on our particular properties. So we are ready when the market decides to use up more of its supply, and you see rent growth, continue to come back up. We've got some assets that, are steady. They're holding, and when that time comes, I think you'll see some really good exits on these particular properties. So, other than that, Arleen, you have any other closing thoughts before we go to the questions here?
No, I mean, I think it's important for everyone to understand that, multifamily has always been a very needed product, providing people with good places to live, which is what we focus on, impacting our residents' lives through great communities that we have, added value to through different rehab elements that we put into them, and our focus on running these properties. It has never been more important. So,
All right, let's get some questions.
all right.
And we're scrolling these up. I think we have a few of them here. Okay.
Okay, what was the average rent for Houston? So the data we have shows 1350, so 1,350. Now that is across different asset classes, but that was the average rent for Houston.
In other words, what properties are due for refinance in 2026, 2027? I would encourage you to look at your investor reports that come through, and you'll have the answers there. Okay, what was the link to your website for tax video?
Yes, so you can go to reepequity.com, go to the resources tab, and look for that tax video there, the webinar there. We also have a tax toolkit that also provides additional detail. It's a white paper that we wrote around taxes. So if you go, again, reepequity.com, go to the resources tab, all of those resources or educational items will be there.
And then you can also send an email to invest@reepequity.com. Okay, great. All right, got some more here. All right, hey, Mike.
Yeah, it says it says Arleen indicated San Antonio was at or below the indicated 2% new construction with 4,600 units. Presume the 2% is of total supply, or is that all rentals or only multifamily. That is only multifamily. Okay. At the present time, approximately how many distressed properties is REEP looking at? We've got about 10 in the pipeline right now, in different markets. So that is something that we just encourage you. If you're in our database, you'll hear about these opportunities. If not, please go to or send an email or go to our website, invest@reepequity.com, and we can add you to that. In many cases, tax value is much greater than fair market value. Can you explain? So, the tax value is the county's assessment of a property's value. For commercial real estate, it is usually based on income. It's not so much based on comps, although we do protest our taxes every year. And we've been able to see significant reductions in our taxes based on doing that. And we will continue to do that as we go into the future. This year, Houston gave us a nice surprise. Harris County, I will say, their values that they came out with this year were actually less than the values they'd come out with last year. So I think they're getting the hint that overall market values are down, so they need to also adjust it on the tax value side. Do you have any new investment opportunities for us to explore?
The first question is, are you in our investor network?
Yeah, please join our investor network. Send an email to invest@reepequity.com. We like to have, there's a QR code up on the screen, but we like to talk to you first. We want to get to know you. We want to understand your investing goals and explain more about how we do things. But would love to have you join us on our next opportunity. There's nothing immediate. As I said, we've got 10 in the pipeline. So we anticipate that we'll have something early first quarter of next year. And it is the volume of deals is down. We were at dinner with a broker yesterday. So the volume is down, but it's primarily distressed assets that they are seeing. So we expect to have some good opportunities in the first quarter.
Okay, let's see. Any other questions, Miranda? No? Okay, so as far as more interaction with you, our investors, REEP investors, and potential investors, we're going to be announcing our events for 2026. So stay tuned for that. We look forward to seeing you in various parts of the country. Other than that, thank you, Arleen. Always a great job and all this great data you present. The people behind the scenes, there's lots of them that help us prepare this data as well. So thank you for them. Miranda, who's been operating this, thank you, Miranda, for getting it all set up. And of course, you guys out there, our investors. Many of you have done very well with us with our properties, and many of you shown lots of patience right now, and that's the key. It's a patience. It's a waiting game right now.
That long-term value creation, as we
still
talked
happening.
about.
It's still happening. It's just baking a little slower right now. So as in any business cycle. So
I agree. And as Jacob said, we're very thankful for our investors, our investor partners. We're thankful for our teams that work hard every day at our properties to take care of our residents. And we're thankful for our corporate team who does these wonderful presentations for us and keeps the lights on, the accounting, et cetera. As I said, we have in-house, everything in-house, so it's nice to have it. But we want to wish you all happy holidays and a very festive New Year's celebration coming up later this month and in early January. And again, we're very thankful to each of you for joining us today and hope you have a great rest of your day.
Thanks for joining us, everyone.